The weirdest part about a real market break is that it rarely starts with a crash on your screen. It starts with hesitation, with quiet delays, with sudden policy changes that are explained as routine, with big players behaving differently than they did last month, buying what they used to sell, refusing to deliver what they used to provide, tightening terms, stretching timelines, and acting like they're trying to protect themselves from something they don't want to name out loud. That's what's happening in silver right now. Something is breaking in the silver market, and the strongest signal isn't a headline or a chart pattern. It's the behavior of banks, because banks are suddenly nervous in a way they haven't been in years. And when banks get nervous about a market this small and this essential, it usually means the stress is real, physical, and already in motion. Here's why this matters for Americans watching from the outside. Silver is not just a precious metal trade. It's a critical industrial input embedded in the infrastructure of modern life. Solar panels, EVs, data centers, electronics, medical devices, defense systems, and power networks. And unlike many commodities, silver is consumed. It disappears into products in small amounts that rarely get recycled. So when the silver market tightens, it doesn't tighten like oil or corn, where supply can surge and inventories can rebuild quickly. Silver tightens like a bottleneck, quietly at first, and then all at once. Stay with me until the end, because the final part of this story is the part almost no one explains clearly. The moment when paper pricing loses control and physical reality takes over. That's the moment banks fear most, and it's the moment that changes everything about what happens next. Let's start with the basic question. What does it mean when something is breaking in the silver market? It does not mean there is no silver on Earth. It does not mean every vault is empty. It means the system that smoothly moves silver from mine to refiner to manufacturer to financial storage is losing flexibility. The market stops behaving like a deep, liquid pool and starts behaving like a stressed supply chain. That stress shows up in the places ordinary investors rarely track: inventory drawdowns, delivery timelines, private contract terms, premiums over spot, and the reluctance of large institutions to make the metal easily available. When banks are calm, they treat silver like a manageable market. They finance supply chains, they warehouse metal, they create products around it, they lend against it, they hedge it, they deliver it. When banks get nervous, they start protecting themselves, and that nervousness often appears in three ways: tighter access to physical metal, greater sensitivity to delivery obligations, and a shift toward holding rather than circulating. Now, why would banks suddenly become nervous about silver? Because silver is one of the most unstable, quiet markets in finance. It is small enough that large flows matter. It is essential enough that industrial buyers can't simply walk away. And it is split into two realities: the paper market and the physical market. This is the crucial point. Most people think the silver market is whatever price they see on their screen. But the quoted price is mostly a paper price. Contracts, futures, digital claims, ETFs, and financial instruments that represent silver without requiring constant physical movement. Paper markets are useful. They provide liquidity, but paper markets can also create an illusion. The illusion that there's far more silver available than actually exists in deliverable, refined form. As long as most participants settle in cash and roll contracts forward, that illusion holds. But when the physical market tightens, when real industry needs real metal, paper pricing starts to lose authority. Banks understand this. Banks also know that once confidence shifts from paper to physical, the market can reprice violently. And banks hate violent repricing because it exposes risk, leverage, and delivery obligations. So what's driving the physical tightness now? First, industrial demand is structurally rising. This isn't a seasonal bump. It's built into the direction of the global economy. The energy transition is silver intensive. Solar panels require silver for conductivity and efficiency. EVs use more silver than traditional vehicles because they rely on advanced electronics, power management, sensors, and connectivity. Data centers, AI infrastructure, and high-performance computing use silver in advanced components. Medical technology relies on silver's antimicrobial properties. Military and aerospace systems use silver in electronics and communications. And while manufacturers work to reduce the amount of silver per unit over time, demand growth is outpacing those efficiency gains. Second, silver supply is not responding fast enough. Silver mines are not like software. They cannot scale with demand quickly. New mines take many years to develop. Ore grades decline, costs rise, environmental and regulatory hurdles slow expansion. And much silver is mined as a byproduct of other metals, which means silver output depends on broader mining economics, not just silver prices. Even if silver becomes more valuable, the supply response is slow. That's a recipe for persistent tightness. Third, above-ground inventories, the cushion that absorbs shocks, can shrink quietly for years. And that's the most dangerous kind of shrinkage because the public doesn't notice until the cushion is gone. Inventories don't vanish overnight. They drain. They get used to fill gaps. They get drawn down when demand is strong. They shrink when supply disruptions occur. And once inventories become thin enough, the market becomes hypersensitive to any new demand. Now add a fourth force. Investor psychology is changing. After years of inflation, debt expansion, and geopolitical risk, more investors are paying attention to hard assets again. Not because they think money is about to become worthless, but because they understand the system has become less predictable. When investors re-enter metals, they often start with paper products. But in a tight physical market, even paper demand can create stress because it raises the possibility of delivery pressure and inventory strain. This is where banks start getting nervous. Because banks sit at the intersection of all these flows, they finance, they hedge, they warehouse, they issue products, they handle delivery chains. When the physical market tightens and demand increases, banks face a simple problem: the risk of being short physical metal at the exact moment the market demands it. And that risk isn't theoretical. It shows up in how banks behave when they sense stress. They start tightening collateral terms. They become more cautious about lending metal. They reduce exposure to delivery obligations. They increase holdings of physical metal. They prioritize their own inventory stability over market convenience. To the public, this looks like nothing. But inside the system, it's a warning signal. It means the people who actually move and manage the metal are seeing a market that feels less reliable than it used to. Now, let's talk about what breaking looks like as it escalates, because this is where the market shifts from quiet tightness to visible volatility. The first stage is subtle. Physical premiums rise even when spot prices are stable. Delivery timelines stretch. Large buyers seek private supply agreements rather than relying on open market purchases. Refiners become selective. The system still functions, but it's less flexible. The second stage is stress. Spot prices rise faster, but physical availability tightens even more. The gap between paper price and real-world procurement widens. This is the stage where people begin noticing something feels off, because the market behaves inconsistently. The screen says one thing, but reality says another. The third stage is rupture, a major event, an economic shock, a sudden surge in investment demand, a supply disruption, or a policy change, hits a system with thin inventories. At that point, prices can jump not because of speculation, but because the market is forced to reprice scarcity. Volatility spikes. Short positions get squeezed. Paper markets scramble. Physical premiums surge. And the conversation changes from, is there a shortage, to how bad is it? Banks fear the third stage because that is where liability and reputation risk appear. If you are an institution tied to the market and you cannot meet obligations smoothly, trust is damaged. Banks survive on trust. They do not want to be the institution caught in the middle of a physical squeeze. This brings us to the big question: what happens next? If the stress continues, the silver market enters a phase where pricing becomes less about chart patterns and more about access. That's when silver stops behaving like a niche trade and starts behaving like a strategic resource. And in that phase, the market becomes extremely sensitive to headlines that would have been ignored in calmer years: mining disruptions, export restrictions, geopolitical escalations, shifts in energy policy, and changes in institutional behavior. But here's the most important thing to understand, and the part almost no one explains clearly. The silver market does not need a total shortage to explode. It only needs a shortage of deliverable supply at the margin. Because pricing happens at the margin, if the available pool becomes thin enough, a relatively small increase in demand can create outsized price moves. That's why silver is famous for sudden spikes. The structure of the market amplifies shocks. So why are banks suddenly nervous? Because they are watching the margin thin. They are watching inventories tighten. They are watching industrial demand stay strong. They are watching investors wake up. And they are watching a market that has long been managed comfortably begin to behave like it's losing stability. And that is the warning Americans are ignoring. Not that silver is the next lottery ticket. The warning is that the global system is becoming more constrained, more volatile, and more sensitive to supply chain reality. In that kind of world, essential physical resources reprice. Markets stop assuming smooth availability. Confidence stops being automatic. If you're still here, here is the final piece, the payoff that ties the whole story together. When a market is calm, paper price leads and physical follows. When a market is stressed, physical leads and paper chases. The moment silver truly breaks out is the moment the market flips from paper lead to physical lead. That's when premiums widen, deliveries tighten, and price becomes a function of scarcity rather than sentiment. That's the moment banks fear because that's when a small market becomes a global signal, one that reflects not just metals demand but systemic stress. So watch the behavior, watch the tightening, watch the reluctance, watch the premiums and access, not just the chart. Because when banks start acting nervous in a market like silver, they're not reacting to a rumor. They're reacting to a system that's becoming less stable underneath. And when stability disappears in a market that's both monetary and industrial, the repricing isn't gentle. It's sudden, it's violent. And by the time the average person hears about it, the move is already underway.